Well, I don't know. Let's bring in former Dallas Fed President Richard Fischer. I know he's been listening to our conversation, and I hope he has. There he is. It's nice to see you again. Are they going to go? Is the Fed going to go crazy here? I mean, what are they going to make of this jobs report? Inflation's coming down. Maybe they're looking at the wrong thing. Are they fixated on the wrong thing?
I keep hearing people say they're looking at the wrong thing. Obviously, so far, they've been looking at the right thing in terms of employment. And total comp is still higher than they would like. That's the feeder for inflation. If you watch, I always watch Jay Powell at his press conference. I know him as a friend, but I watch his body language. And if you watch what he was doing, where he stopped reading from the book of his briefing notes, looked right into the camera or to the questioner, and addressed the inflation issue and the components of what they're looking at with some passion, this is deep in his craw. And I think what just happened here with the unemployment rate going down so low, with 11 million jobs now open, just firms up his view. And we're living in a 4% world. I have said repeatedly, I think including on this show, that there's a real possibility that they take the terminal rate above 5%. But we just have to get used to that. And that just changes the way you apply multiples and valuation and the way you deal with the present value of holdings. And I don't think they're going to stop here. I think they've got a couple more quarter points to go, and then I think they'll hold. And I think the odds of their cutting this year are very slim.
So the market's got it wrong. The market is getting it wrong.
The market so far has gotten it wrong, and it's early in the year. But I don't bet against the Fed. That's an old rule, and I would continue to adhere to it.
It's interesting. You know, you're like the third person who spoke of Powell's demeanor as he was appearing and speaking to the press. He was calm and he was cool and collected, and as you suggested, he was. I mean, that's because he thinks he's winning. He's winning, but he doesn't want to snatch, as Joe has said, defeat from the jaws of victory, because inflation is coming down. It's probably coming down faster than they thought that it would. The problem is they haven't been able to crack the labor market. And maybe they're not going to be able to. And maybe they should stop trying and just realize that that's the key to the soft landing they hope to engineer.
I sat on that committee for 10 years. But one of the things that's beaten into you is don't make the mistake of the 1970s. And if I'm absolutely convinced what they don't want to do is now make two big mistakes. Obviously, the first was the transitionary inflation argument, which is kind of silly. That had egg on their face. And now the worst thing that can happen is for them to stop early, have inflation rear its ugly head again, or not come down sufficiently. So I do think, guys, that they are going to err on the side of doing too much if they err. They have a very strong labor background here. Remember the dual mandate that they have on labor and employment, and inflation. And there's no way, I think, no way on earth that this chairman wants to go down in history of having made two big blunders and look like an Arthur Burns.
But respectfully, I would say that his credibility is not our problem. Like, if he blew it the first time, just get it right this time.
His credibility is essential in order for them to do what they're supposed to do as a central bank vis-a-vis the real economy. And the market is an emotional mechanism that comes and goes. Mr. Market is very schizophrenic on occasion. But the job of the Fed is to deal with the real economy. And if you do it right, then the markets will prosper. And that's the mentality you have when you're sitting at the table.
But how do they know it's too early to stop? How do they know?
You don't.
They haven't even given it time to filter through and figure out exactly what the impact of what they've already done is. That's the greatest risk that they have.
That's true, and none of us know the formula anymore because we don't know what the adjustment time is, the lag on monetary policy impacting the real economy. So I'm sure, and I know, that they have discussed this. They've got formulae and equations. But in the end, guys, it's just human judgment. It's 19 earnest people sitting around the table trying to apply their best judgment as to what the right thing is. And you got to give them some credit they have been signaling openly before every meeting and well in advance what they're likely to do through the Wall Street Journal and other leakers, other whisperers. And I think it's given the market plenty of information in advance. You're not going to see what happened with Ben Bernanke in 2013 when we had the taper tantrum. And you're not seeing the kind of mumbling that Alan Greenspan was such a master of, or the lack of information under Paul Volcker. This is the most transparent FOMC I've ever seen. And I think that's what the market just has to deal with. Wow. And instead of saying they're wrong or they're right, that doesn't do any good. They're going to do what they need to do to fulfill their mission. And I actually think they're doing a good job.